Welcome to Outside the Dollar. I'm glad you're here today because this episode is one I've been looking forward to building for a while.
Central banks are buying gold at a pace not seen in decades. Institutional analysts at Deutsche Bank and Goldman Sachs are publishing detailed forecasts on where prices could go. And retirement savers are asking whether their 401ks are actually keeping up with inflation. Three very different groups, all arriving at the same question around the same time. That's worth paying attention to. The reasons aren't identical, but they're connected. Deutsche Bank has put forward scenarios projecting gold well above historically familiar levels. Goldman Sachs has been tracking central bank demand closely and publishing analysis on what's driving it. And according to the World Gold Council, countries like China, Russia, India, and Turkey have been steadily building gold reserves, specifically to reduce their dependence on the US dollar. That's a coordinated structural shift, not a market rumor. It's also showing up in personal finance conversations. The New York Post ran a piece this month noting that surging energy prices, a 3.3% annual inflation print, and a slowing labor market are pushing people to ask harder questions about what's protecting their savings. Those aren't abstract concerns. They're showing up in real household budgets. Deutsche Bank has put forward a scenario where gold reaches $8,000 per ounce by 2031. That number deserves a moment before we move past it. Banks build price scenarios around specific conditions. Deutsche Bank is saying if these factors hold, the math points here. So the useful question isn't whether you trust the number, it's whether the conditions behind it are actually playing out. Two conditions drive this projection: sustained demand that keeps growing and supply that physically cannot keep pace. Gold doesn't come out of the ground quickly. New mines take years to develop and permit. Even when demand spikes, the supply side can't respond fast. That structural lag is built into every serious gold price model. And on the demand side, the World Gold Council has been documenting exactly this pattern among BRICS-aligned central banks: steady, ongoing accumulation running at historically high levels for several years now. China, Russia, India, Turkey, these aren't one-time purchases. They're a sustained repositioning away from dollar-denominated assets, and it's been building for years. So the scenario Deutsche Bank is describing isn't built on speculation. It's built on two observable forces: constrained supply and growing institutional demand. If both continue on their current trajectory, the math behind that $8,000 figure starts to make more sense, which is exactly why Goldman Sachs' data matters here. If central bank buying continues at the pace the World Gold Council is documenting, the demand foundation Deutsche Bank's scenario rests on isn't theoretical, it's already in the numbers, and that's exactly where we're going next. So Goldman Sachs has put a number on this. According to their analysis, central banks are expected to buy roughly 60 tons of gold per month on average through 2026. Not a one-time surge, a sustained, ongoing pace of accumulation. Here's the thing worth sitting with. That's not a prediction about where gold prices are going. It's a forecast about behavior, institutional behavior, from the most conservative buyers in the global financial system. So what does reserve diversification actually mean? Because that phrase gets used a lot without much explanation. Think of it this way. Every country holds a mix of assets in its national reserves: dollars, euros, government bonds, and increasingly, gold. When a central bank diversifies its reserves, it's spreading that mix so no single currency or asset can destabilize the whole portfolio. Gold fits that role because it has no counterparty risk. You can't print it more, no government can default on it. That's meaningfully different from holding U.S. Treasuries, for example, where your return depends on a foreign government's fiscal decisions. Gold just sits there, holding its value independent of anyone's policy choices. Now, here's where this connects back to the Deutsche Bank scenario we walked through. The $8,000 case rested on two conditions: constrained supply and sustained institutional demand. Goldman's 60 tons per month figure is direct evidence on that second condition. It doesn't confirm the price target, but it does show the demand foundation is real and ongoing. The Lear Capital research makes a related point worth quoting directly. Central banks, they write, are not short-term traders. They buy gold for strategic reasons: reserve stability, currency protection, long-term monetary independence. That framing matters because it changes how you read the demand signal. This isn't momentum trading, it's structural repositioning. So here's the honest question. If the largest, most risk-averse institutions in the world are consistently adding gold to protect purchasing power over time, should individual investors at least consider whether precious metals could play a parallel role in their own financial picture? Not as speculation, as a question about long-term reserve logic applied at a personal scale. The NY Post piece on 401k rollovers actually flags this backdrop directly, citing inflation running at 3.3% annually and energy prices surging as context for why retirement savers are looking at Gold IRAs more seriously right now. And speaking of who's doing this buying at the institutional level, the story gets geopolitical fast. The countries driving this accumulation aren't random. They have a specific set of reasons for moving away from dollar-denominated assets, and that's exactly where we're going next. So who exactly are these central banks loading up on gold? That's where this gets interesting. The Lear Capital research makes this concrete. China, Russia, India, Turkey, Saudi Arabia, BRICS-aligned nations collectively have been steadily adding gold to their reserves. And the reason isn't mysterious. They want less exposure to the US dollar and less dependency on Western financial systems. Here's a fact worth sitting with. The dollar's share of global foreign exchange reserves has dropped from around 72% in 2001 to roughly 58% in 2024. That's a real shift over 2 decades. Now, before anyone reads that as a dollar collapse story, hold on. The dollar still dominates global trade and finance by a wide margin. No other currency is close to replacing it. What the data shows is a gradual diversification, not a crisis. Think about it this way. If you held 72 cents of every dollar in one asset and slowly moved to 58 cents over 20 years, you wouldn't call that a disaster. You'd call it a portfolio adjustment. So why gold specifically? Gold has no counterparty risk. It can't be printed. A country holding gold isn't holding a claim on another government's promise. That's the structural logic. And Lear Capital frames it as exactly that, a structural shift, not a short-term trade. Central banks aren't moving quickly. They're moving deliberately. And when countries across multiple continents make the same slow, deliberate choice over years, that's worth paying attention to. Here's where the individual investor question comes back in. We talked about Goldman Sachs forecasting roughly 60 tons of monthly central bank buying through 2026. These BRICS nations are a big part of that number. Their logic? Reduce currency risk, hold an asset with no counterparty exposure. Does that logic apply to a retirement account? Does it apply to someone looking at their savings and asking the same question those finance ministers are asking? The forces aren't identical, but the underlying concern, what happens to purchasing power when currency exposure is concentrated, that question doesn't change based on the size of your balance sheet. What's interesting is that gold's properties don't scale down or up. An ounce in a national reserve and an ounce in a self-directed IRA carry the same fundamental characteristics. And that's exactly the territory we're moving into next. What practical tools exist for individuals who want to think about this seriously? So we've traced the institutional logic all the way from central banks to your retirement account. Now the practical question, what can you actually do with this information? Silver is worth spending a moment on because the recent pullback has created some noise around a metal that actually has a strong underlying case. Yes, prices have come back from recent highs, but the demand story hasn't changed, and in some ways it's gotten more interesting. Here's what makes silver different from gold and why that difference matters right now. Silver sits at the intersection of two separate demand drivers. The first is monetary demand, where investors hold it the way they hold gold, as a store of value and a hedge against currency erosion. The second is industrial demand, and this one is growing fast. Silver goes into semiconductors, solar panels, electric vehicles, and the physical infrastructure behind AI. The Silver Institute has documented a structural supply deficit in silver for multiple consecutive years. Demand has been outpacing mine supply. That's not a narrative, that's a balance sheet problem that physical markets eventually have to price in. So when silver pulls back after a strong run, the honest framing isn't just pause or reversal. It's, has anything changed in the underlying supply and demand picture? And right now, the answer is no. The industrial buildout isn't slowing. The monetary case hasn't weakened. What's changed is the price, which means some investors look at a pullback like this as a chance to buy an asset with a real demand floor at a lower entry point. That's a perspective, not a recommendation, but it's a perspective grounded in the data. Now, for listeners who heard everything we've covered today and are asking a practical question, there's a tool worth knowing about. A Gold IRA is a self-directed retirement account that can hold physical precious metals, not paper claims or ETFs, actual metal. The NY Post published a guide on this recently, noting that a properly executed rollover from a 401k moves funds without triggering a taxable event. The key word is properly. Rules exist around which metals qualify, how custody works, and timing. Getting those wrong creates tax exposure. Lear Capital offers free IRA setup, free gold and silver guides, and a price match guarantee, which lowers the friction of getting started.
Here's the weekly takeaway. Deutsche Bank, Goldman Sachs, and central banks across multiple continents are all paying attention to gold right now. The reasons we've walked through aren't the same as a stock tip. They point to structural forces, debt levels, currency competition, purchasing power over decades. And silver sits right alongside that story, with an industrial demand layer that gold simply doesn't have. The honest question isn't whether either metal is about to spike. The question is whether precious metals have any role in protecting what you've built over the long term. If that question landed for you today, Lear Capital can help you think it through. Their number is 855-271-2873. That's a wrap on today's episode. The key question we kept coming back to: why are central banks, institutional analysts, and retirement savers all focused on gold and silver right now? The answer isn't a single data point. It's a set of structural forces worth understanding, whatever your financial situation looks like.